Hi, welcome everyone. Can you all hear me? Cool, it's working. So I think it's no surprise that we are now living in a hyper-reactive world where a single tweet can move global markets like the Shanghai Exchange by 5% in a single morning. I'd like to get a sense of the international scene and how that affects the multimodal situation here in the US. And to do that, let's start with Henry, who's got a really good perspective on the international markets.
Sure. For the U.S., obviously, China is a super important player when you're looking at imports, and you're looking at the trade deficit. Over the past, really since 2007, China and Hong Kong have comprised about 40% of market share in terms of U.S. imports. So this trade dispute that we've been having over the last, better part of a year has had a tremendous impact on the international markets. Specifically when it comes to ocean container shipping, we saw peak season, which is normally a period that's around August, September. Retailers really getting a lot of imports in prior to the holiday season.
Preloading that shipping season.
Exactly. Saw that really broken in two with U.S. importers worried about the additional tariffs. So spot rates spiked as a result, and they've stayed elevated, year over year since. Looking at today, and obviously the prelude to this, what's going to be happening hopefully this week. Hopefully there's going to be a
big week.
Exactly. We've really seen the entire supply chain shaken up. We've seen importers starting to source from Vietnam, Indian subcontinent, places like that. It's kind of a rearranging of the supply chain.
And is that a risk management function?
Absolutely. U.S. importers do not want to be exposed to this, potential tariffs. So really, they're looking at places like Vietnam. Even like I was talking about earlier, Europe is an option. It really just depends on the commodity.
And with that preloading of these supply chains to ward off any potential trade impact, how's that affecting, the intermodal side? Are we seeing a shift from rail to truck or truck to rail to make use of almost warehouses on wheels?
What we've seen so far is this year is, the market for trucks is extremely loose. And the intermodal rates have kind of held themselves up. And there's beginning to be a significant gap there to where they're attractive to the truckers if they need to, move assets, keep assets moving. So there looks to be more competition than ever between the two modes. And last year was a gigantic road to rail, just because capacity was crazy. Yeah. And this year it's so loose, it seems like it's going the other way a bit.
And when we've previously had major supply chain disruptions on the ocean side of things, the Hanjin bankruptcy, for example, we've seen a shift to shippers moving to air to compensate for the uncertainty associated with some of the ocean movements. What do you see going on there, Jesse?
So that's right, Patrick. So when you had the Hanjin bankruptcy, we saw customers, shippers, and consignees concerned about their supply chain, the lack of available ocean capacity. We did see a short-term shift to air, and this is not uncommon. Last year, out of Asia, out of China and Hong Kong, we saw a prolonged peak season with higher pricing as a result of the concern about tariffs and the need to beat the tariffs. Ocean rates went up first. Air rates typically followed 30 to 60 days later as we got closer to the expected implementation date of the tariff. I mean, my view is air carriers overall are flexible to the extent that there are new threats to the global supply chains. They adapt, rates may go up, capacity may tighten. Ultimately, new freighter capacity comes into the marketplace. If it really gets bad, charter capacity comes in for customers willing to pay $500,000 or $600,000 or even $800,000 for a 747 charter. But air can adapt pretty quickly. I think the question is, can shippers and consignees and the consumers adapt as quickly when rates go up and the cost has to be passed along?
Yeah. And so we're working within a countdown of sorts to Friday. $200 billion on the table. I know the Vice Premier is traveling to DC to have these conversations with the administration. What happens if we get a deal done? What happens if we don't get a deal done?
Well, I guess we can start with what happens if we don't get a deal done. Since we were showing the effects of really what happened, during the last year with the threat of the tariffs, I would expect there to be a very similar, spike in spot rates as importers, again, being super concerned about, beating any tariff deadlines or any increases because, really it's announced from 10% to 25% on Friday. So there's not really a lot of time to get, since it's usually a 14-day transit to get it into California, West Coast. So really, I would expect those rates to stay, really spike per 40-foot container. What about with air cargo, do you think?
So I think if a deal doesn't get done, what ultimately will happen, manufacturers adjust. They're already adjusting. They're diversifying their supply chains. So what may have been manufactured in China at one point is now being manufactured in Vietnam. There's production taking place now in the Indian subcontinent that formerly took place in China. So ultimately, the world adjusts. Air cargo will adjust as well. We're seeing increased freighter services into Hanoi, Vietnam, to pick up that additional demand, and additional freighter services are expected into the Indian subcontinent to pick up that demand. So ultimately, once we know what the game plan is on the U.S.-China tariff talks, manufacturers will adjust, and the air cargo industry will adjust, and I'm sure ultimately the ocean cargo industry will adjust.
And Mike, your insights on this?
It depends, like they said, it depends on how much time he gives them, how much warning. Of course, if they don't reach an agreement and he extends the timeline, that could create another pull forward again, like we saw at the end of last year, which starts in international, and then it spills over into intermodal, and rates, contract rates will hold for a while, but they'll only be able to cover their commitments. So then you move to spot, and the spot rates out there were insane. And the same scenario would happen. And I'm not sure the warehouses are fully empty out there yet. So
I was going to ask, warehouses, the inventory levels have been pretty high. What's the capacity situation, and how does that play into the transportation rates?
Yeah, I mean, if we're not able to get a deal done, and there's a huge surge in imports, certainly those inventory levels are going to rise substantially. Even over what they are currently, which they're extremely elevated, even from last year's pull forward. So we were going to have to find other places. Basically, U.S. importers are going to have to move those further inland. We've seen a big jump in Stockton, California. Some really, a lot of warehousing companies have been building massive warehousing spaces. A lot of that's from the Bay Area, but a lot of that's to help with a lot of these, this surge in imports and potential surge and even more imports.
Patrick, I know a lot of our discussion has taken place with regard to U.S.-China, and that's obviously the immediate issue this week. But there are also some significant issues on the burner with Europe. In fact, there's 4 major trade issues. One involves European subsidies for Airbus that the U.S. is very unhappy about. It's a 14-year dispute. You have a counter dispute about U.S. subsidies to Boeing that the Europeans are unhappy about and are proposing counter tariffs. I believe it's about $20 billion of counter tariffs. You have, going back to earlier this year, the concern about European automakers and whether European autos or German autos are a security threat, national security threat for the United States. And then you have the general U.S.-EU trading relationship and a commitment to eliminate tariffs entirely. The European Union recently came forth and said we're willing to talk about eliminating all industrial tariffs. They didn't put agricultural tariffs on the table. We understand that the U.S. administration was not happy about that. But that's percolating in the background. We shouldn't lose sight of that. And that can drive its own issues with respect to ocean freight, intermodal, and air later this year in terms of the transatlantic market.
And of course, lingering Brexit uncertainty.
Yeah, so you have that whole uncertainty about Brexit that I guess has been pushed off to later in October. So I think there's just a lot of things that could happen that could either dynamically change capacity situations or rate situations in all of our modes this year.
So transatlantic and trans-Pacific lingering questions.
Yeah. And we have the U.S.-Mexico-Canada trade agreement as well.
Yeah.
That hasn't been ratified. So it'll be very interesting to see what happens with that. That could affect supply chains as well.
So the country is encircled in uncertainty, all the borders.
One thing that was really interesting we were studying recently is just the port of LAX, port of Los Angeles and Long Beach. You know, it's really a main gateway into the country for imports. So when volumes build on the level that they have within the last year, you know, a similar situation would have been when there were port labor disputes, really around 2014, 2015. There were a lot of ships. I don't know if you saw the pictures where all the ships at 12,000 TEUs sitting offshore. You know, it looks like potentially 20 of them. But once all those came in, inventory levels rose, spot rates in the truckload market rose, and as we've
Ports
seen,
got clogged.
Yes, exactly. As we've seen recently, you know, Craig Four was showing us about new truck orders and how that's associated with, you know, increase in spot rates. Those are two highly correlated things. That brought on a lot of new capacity into the truckload market. So we're kind of seeing that same type of situation where a lot of capacity comes in and spot rates in the truckload market drop off just because there's so much. You know, the getting was good. Everybody really, you know, went and invested in new trucks, and now there's too many trucks on the road, and we're seeing spot rates kind of take a dive.
And Mike, this morning you had an interesting chart that kind of spoke to this transition.
Yeah, no, capacity's as loose as it's been in several years, and you know, like we said, the over-the-road spot rates are diving. Intermodal rates are holding steady. They're actually month over month, they've actually ticked up. The contracted rates are pretty much at an all-time high. Yet intermodal volume's obviously down a bit. It's nothing to panic about yet, but it just shows there's so much competition for freight of all kinds, especially, and the truckers react quicker. They're more nimble to drop rates because they don't want to lay drivers over and, you know, have to reseat the trucks. So they're way more aggressive. The rail guys, they'll go through a dip in volume short term and to hold their rates. I mean, they'll take a little punishment, but they've worked hard to get those rates up there, and they're not going to have a short-term panic and just lower rates.
And in y'all's opinion, is this financial uncertainty affecting operations at these companies? We mentioned the Hanjin bankruptcy. You know, could the depression in these ocean rates because of the capacity, could this end up with another, you know, financial situation where we've got container ships full of goods stuck offshore with the threat of arrest?
Well, I think that's, you know, it being so recent in memory for a lot of these people, absolutely. I mean, the people that were exposed when Hanjin indeed went bankrupt certainly remember that. That was only a few years back. So I think that's certainly on people's minds. I think there's certain carriers that could be exposed with any potential increase in volumes short term. Therefore, you know, when all the volume moved in 2018, Q4 2018, prior to the tariffs, it should have really moved after Chinese New Year. Mm-hmm. So there was a dramatic drop in volume during that time period, and you could see that in the spot rates and how they played out. And ultimately, ocean carriers ended up signing contract rates really around like $200 more than last year. And that you could claim that that's fairly unsustainable, especially with the IMO 2020 coming right down the pike.
Got the GRI increases that some big numbers are being sent out in emails. I'm not sure if those are going to be able to hold.
Sure, and that's more, you know, the FAK market. But you know, contract rates, like with your biggest importers, only going up $200. A lot of people are uncertain if that's enough to cover the cost of the increases with the IMO 2020. So there's certainly any volatility in the ocean market right now could play out bad for a few carriers, and we may see some mergers or even, you know, some acquisitions as a result. So it'll be interesting to see how that does play out.
And we've had some financial situations on the truckload side of things. Mike, do you see a similar situation playing out where this capacity is going to depress rates, where we might have some, you know, additional financial challenges for the over-the-road trucking community?
We certainly don't wish any ill will on anyone, but there's, you know, so much capacity that it has to get pulled out somehow. I mean, no one likes to see companies just closing up shop, telling the drivers to, pull over, game over. That's no good for anybody, but somehow some has to be pulled. And earlier, he was, the pull forward, everybody was, intermodal's getting the bad rap for being down. Like, it's a total of 1%, but like Henry was saying earlier, all that freight that got pulled forward at the very end of last year, that was freight that was supposed to come in January. So, intermodal numbers actually probably got a little inflated last year for that in the fourth quarter, but they're paying the price, in the first, second quarter, because that's freight that should be moving at this point. Yeah. So they got a boost in the fourth quarter, and they're taking a ding now, but I think it'll pick back up.
And Jesse, are the air providers, are they more protected, or are they facing any kind of headwinds?
I don't think protected is the right word. I think, first of all, the aviation industry since September 11, which was almost 20 years ago, has gone through several rounds of painful restructuring. And now today you have companies that, for the most part, international airline companies, and certainly your FedExes and UPSs and DHLs that are very healthy overall. We're coming off 2 very strong years in the air cargo industry. This year has started out in low single digits, worse than last year, but last year was a very, very strong year. What concerns me is a prolonged slowdown if we don't reach agreement on these trade deals with China and Europe. High jet fuel prices, jet fuel can be 20% or more of some airlines' total operating expense if we don't get that down. And if you have a low demand, it's very hard to pass along those costs. So if you have a prolonged situation where demand is low, jet fuel prices are high, you could see several of the weaker providers falling out of the game or having to do something to restructure their costs.
Mm-hmm. And so we're approaching peak shipping season, and we're running a little low on time. Can I ask each one of y'all for kind of a prescription for shippers to plan in this time of uncertainty?
Sure. I think hopefully we'll reach a trade deal. I think most everyone is thinking that's highly likely. So some things to watch out for in the ocean container industry this year. It's just like what I was saying about the financial situation of some of these carriers. Some could be very vulnerable if there is any volatility that's created as a result of further disputes. The IMO 2020 is obviously a big win, and I know we've just covered that, but increased costs there. And also just the reorganizing of the supply chain, really ocean carriers adjusting to that type of thing. We've seen some new service introduced direct from Vietnam to like Oakland, and seen carriers really pushing Pacific Northwest routings, things of that nature, just to prevent any further congestion in LA.
Great.
But that's really most of the ocean container
and Jesse?
industry.
So within the air industry, there are sort of known peaks. Seasonally, typically the fourth quarter prior to Christmas, typically September, October, November, you'll have rate escalations, especially out of China market, Southeast Asia, some out of Europe. So, I would expect as long as we continue to have a relatively strong U.S. domestic economy and we have trade deals that haven't been resolved in a negative way, I would expect us to have a normal fourth quarter peak season. I would expect any other peak seasons, which are mostly for perishables in the second quarter, West Coast, those will move normally. I think the real wild card is what happens with trade agreements, both with China and Europe, and then of course Mexico, Canada.
And Mike?
I believe intermodal is going to rebound. The fact they're only down 1% with the winter and the floods and freight that got pulled forward in the fourth quarter last year and didn't get credit for it this year. The economy is strong. Consumers are still spending. We're going to have the normal retail. So I think U.S. intermodal they'll finish, slightly up, but nothing like the craziness of 18. That was nuts.
Great. Well, I want to thank my panelists. I'd encourage everybody to check out. They are on FreightWaves now 5 days a week and do some incredible email newsletters. If y'all have specific shipping questions, you guys can find them at the Market Experts desk out in the main hall. Thank y'all.
Thank you.
Thank you.